Alright, welcome back DeFi House community, and in this video I want to explain to you in detail when to choose stable versus stable, volatile versus stable, or volatile versus volatile pools. So this lesson is very important, so please pay attention because it can make you or break you, so to speak. If you position yourself well, then basically you are good to go and earn the fees all the times, and in worst case scenarios it's easy to recover. But if you position yourself poorly, then sometimes recovery from the losses you occur due to market volatility can be very difficult and long, and sometimes even impossible. So that's why you really have to understand when to choose what and what kind of risks you are getting involved based on your risk profile and goals. So the golden questions, two golden questions you have to ask yourself every time before depositing into the liquidity pool. The first one is, what is your goal? And second one, where is the market? And by goal, I mean, are you deploying to accumulate more asset, specific asset, or just to earn the fees, convert the fees to stable coins, withdraw them and use them and spend them? Or maybe your goal is to go ahead and expose yourself to volatility and earn fees plus uh, additional gain in value from volatility. I mean, there are multiple goals you can achieve when you deploy into the different liquidity pools. But the most common one is simply deploy the capital so you can earn predictable cash flow. This is the most common thing, right? You want to be deploying money, you don't want to be losing money, even if you have a temporary moments of downside volatility, which is not that bad if you know how to rebalance the pools professionally and still continuously earn the fees. But your goal should be simply build a cash flow. For me, on all of my DeFi pools, I not all of them, but I would say 80% of my pools, my goal is for the pools to generate me cash flow. And then I use the generated cash flow to either reinvest, compound, or separate some of the capital for spending or fund capital, meaning that I will deploy into leveraged positions, I will deploy into riskier degen assets positions simply to have fun and kind of volatility trade, so to speak, right? Get myself exposed to higher volatility and higher volatile assets. So, and the second question is, where is the market? And this is also very important thing to understand. Is the market trending up, down, sideways? What is the current state of the market? Because that should also help you to understand and determine what kind of pools to deploy into. So throughout the video, I will be using these annotations: SS, VS, and VB. So SS is stable versus stable. For example, liquidity pool USDC versus USDT. You will be surprised how much money is deployed into such pools because they are low risk, pretty much non-existent risk, besides some sort of a depegging or something. But basically, a lot of people are swapping in between USDC and USDT because some assets are available against USDC pair, others against USDT. Some people want to send USDC, some people USDT. So you will be surprised to see that a lot of capital and volume is being generated on these USDC, USDT pools. Not only them, there are many different stablecoins opportunities, and I will cover some of them as we move forward. All right, just stick with me. I have thousands of videos planned. I just don't want to be uploading 50 videos a day. Okay, so we just step by step. All right, then we have VS, which is volatile versus stable. So all of my mostly used pools like Sol USDC, ETH USDC, etc. And then we have volatile versus volatile. So for example, you have Avantis versus ETH, useless versus Sol, AI16Z versus Sol, any other pool where you have two volatile assets. In most cases, it's going to be some sort of a freshly launched pools, and in most cases they will be in Solana, because Solana is still the king of new launches, meme coins, all of that stuff, and all of those pools are usually against Solana and not stablecoin. So if you aim for extreme safety and stability, then you want to be choosing SS pools, stable versus stable. This way, you are not exposed to any external volatility. So basically, you deploy both stable coins, both of them are stable and they should stay stable, right? And you're basically just earning way lower returns, but those returns are extremely low risk and very safe, so to speak. And there are multiple ways to manipulate on the stablecoins opportunities. The most easiest one is, of course, to lend your stablecoins and earn interest. The second level is to get into the LPs that I'm showing you right here. For example, the first stage is looping. No, the first stage I would say is creating yourself a synthetic leverage where you deploy some stable coins, you borrow another one that is cheaper to borrow, and then you deploy into liquidity pools, so you earn from two places. I mean, there are multiple ways, and the third one and the fourth one I would say is the looping, where you deploy into the liquidity pool two stable coins, but you borrow against your LP in more stable coins and you redeploy, so essentially creating this leveraged effect as well. So as you can see, I just took a few screenshots from some of the platforms. So we have a PayPal USD versus USDC, and they have a 25.5 million in TVL, 96 million weekly volume, which is a lot. And as you can see, these APIs are fairly, if you think about that as a stably coins pools, these returns are fairly decent. And you can also expose yourself to a bit more leverage on some of the cases, and you can even amplify these returns as well. But you have, and these are all on Solana in this example, USDS, USDC, also a fairly active volumes. You have USDG to USDC. This is non-existent because they're really stable. They are, even though the volumes are pretty high, but there is no point to pay more fees because it's just one asset to another, and there is no margin, so to speak. There is no that spread that can generate API, so to speak. You just change from one asset to another, and they are most extreme, and these are both extremely stable, meaning that even the slightest variation is almost non-existent, and that's why these returns are extremely low. Okay, and now if we look a bit of a more across chains, as you can see, there are a lot of different pools with stable versus stable opportunities, and some of them on Ethereum, for example, on Uniswap and on Unichain, they have both 24 million plus TVLs. They also have been generating over 40k in fees over the last week, just an average number, so to speak, right? So, and these are two stablecoin pools as well, so those returns are low but still existent, right? You have another options on Base, on Arbitrum, on also on BNB chain, on Polygon chain. So there are places to deploy into the stablecoins if you wish safety and extreme comfort while being in DeFi, okay? And even to be honest, if you deploy into Orca, for example, on Orca in two stablecoin pools, you will generate a very small yield, right? But you will also be able to borrow against it. I have a video on the knowledge vault, how to borrow against your Orca position, and then use the borrowed capital in more volatile assets while those are working. I mean, there are endless ways to expose yourself to better options, right? But if you aim for extreme safety, this is a very good way. Just stable coins, that's it. And there are many more stable coins that are not USDC, USDT, but way more volatile ones, so to speak, not in terms of depegging, but in volumes and uniqueness, because you may find a lot of different rewards for stablecoin pools as well. And actually, yeah, I have this opened, as you can see, the farms on USDC, USDT, and some of the dexes, less known dexes, are usually giving rather than rewards rather than trading fees. So for example, there are multiple different wrapped stable coins, voted stable coins, etc. on different protocols that are giving very high APIs just for stable coins, but usually you will get that reward coin, the rewards in their coin. In this case, it's going to be sushi and whatever else this may be, coin as well. So you are getting volatile coins in exchange for just holding two stable coins. So sometimes it also makes sense. The same applies to black hole DEX that I spoke about on the last video that I posted about. I showed you on the strategy room the black hole DEX. So they're also giving rewards in black coins just by providing two stable coins as well. So there are multiple options for safety. Now, volatile versus stable pools are the most useful. You are exposed to one asset only, while the second asset remains stable, and this includes all examples like Sol USDC, ETH USDC, SU USDC, etc., Avantis USDC, Aster USDC, anything you can imagine. I mean, all the pools. One asset is volatile, second one is stable. So this is the most common and most useful pools to deploy into. They are not always the best, but they are always the best bet, no matter the market conditions, more or less. So these pools provide the most logical risk management while keeping the returns on a higher side. So you can definitely earn 0.2, 0.3, 0.7% daily, depending on the range and volumes, but you are only exposed mostly on just one asset, on the price of one asset. So if we look at an example, and the problem with some of these pools, volatile versus stable, is if the market is moving in a very strong upside momentum, and then the problem becomes a problem, because if you set the range on Sol USDC to be, let's say, 220, 290, okay, so that's your range, 220, 290, and let's say current price is towards 290, 270 or something, right? Doesn't matter. So when the price of Solana reaches 290, your upper limit, you are out of range and fully converted to USDC, your second asset. So if Sol continues to climb up, you are missing out on potential profits unless you quickly exit the pool and swap USDC back to Sol. But even if that's the case, on the way up, as you had your Sol and USDC, if Sol momentum was very strong to the upside and you haven't managed to generate a lot of fees, right, then that exchange from Solana towards USDC on the way from 220 to 290 was also very quick. So you lost a bit of potential profits, like I like to call it opportunity cost. People call it impermanent loss, but it's not a loss, it's just more like opportunity cost if you get out of range from the upper side, meaning that if you simply held Solanas, you would have more money, right? Unless you've been in range for a while and eventually Sol break out, then your fees generated in most cases going to be offsetting any opportunity costs, and you're going to be still in a nice profits eventually, like net profit. But the problem is that if Solana goes up to 290 pretty quickly and it breaks above and continuously going to climb towards 295, 300, 310, 320, right? You are in USDC, and if you are not aware of that, or you are somewhere out or whatever, you're not just able to quickly react, you are losing on potential profits like opportunity cost, because you are sitting full in USDC while Solana is flying up continuously. Yes, that 50% of the fees that you generated will increase in value as well, which is a good sign, but it's not gonna cover, of course, the whole opportunity cost that you will have if you would be fully in Solanas, right? So this is one of the problems. And even if you manage to get out at, let's say, 295 or something and immediately swap, you will be paying slippage. If you do it very quickly on a random, as quickly as possible, you will lose a bit of price impact there, and then you will be fully in Solanas. But essentially, at the end of the day, you will be still experiencing opportunity cost, right? Which is not a actual loss, it's just opportunity cost, that you were able to generate more income just by holding the asset rather than being in the liquidity pool. Okay, so this is like the biggest thing why, if the market is really bullish, really strong, these pools where you have volatile versus stable can a bit underperform in comparison to just holding the asset, unless you've been in range for a while. Unless you deposited mostly in USDC, then the price dropped down over here, you accumulated quite a bit of fees here, and on the way back up, so those fees also increasing in value, and then you get out of range, then of course you will stay profitable. But the worst thing can happen is if you deploy into the pool and very quickly, within a day or two, it just went crazy up and you are out of range, you don't have enough fees generated, right? And you are fully in USDC and you are like, oh, what happened? I wish I just held Solanas and I would have more profits. So sometimes it happens, so you have to understand that as well. Now, volatile versus volatile pools carry the most risks, but can generate much higher returns if it's timed well. It's not very common that I use these pools. For me, they are within the DGen risk pools, but this includes pools like Jupiter Solana, Fartcoin Solana, AI XBT ETH, etc. So basically you have two volatile assets. One will be low cap usually, and second one will be a big coin like ETH or the ecosystem native coin. Because for example, if you have Jup Solana, Fartcoin Solana, Useless Solana, GP Solana, etc., all of those launches are basically happened on Solana and they're paired against Solana. So you will have one coin that is launched on that chain and another one that is the native on that chain, right? And the same thing applies to ETH, AVAX, BNB, etc. So they are very good. These pools are very good when the market is moving up and very strongly, because that way, if you are out of range from the upside, you are fully converted to a second asset, right, which is also exposed to volatility, so you can profit from continuous upside. And let's take a look at an example. So let's say that we have a pool, Jupiter versus Solana pool, and the Jup price is 90 cents. The range is 66 and 1.2. So this is the range, 66, 1.2, and currently 0.9. And at this point, because you are pretty close to 1.2, the upper limit of the range, you are mostly converted in Solanas, in second asset, Jup versus Sol. If price will go down towards 0.66, you would be converted mostly to Jupiter. In this case, you are being converted to the second asset, which is Solana. So if Jupiter moves above 1.2, you are fully in Solanas, which is still good, because if Jupiter is moving up, right, and Jupiter is a Solana ecosystem token, it means that in most cases, 9 out of 10 cases, Solana is also moving up, right? So most likely the whole market, the whole ecosystem is moving up. So even if you are out of range, you stay exposed to Solana movement. So at this point, if it goes 1.2, you are fully in Solanas, and even if you are out of range, just keeping that position there, you're still exposed to Solana movement. And if Solana is moving higher and higher and higher, your deposit value is also increasing, and both the fees are increasing because you are deposited in Jupe Sol, your fees are in Jupe and Sol, and if everything is going up, it's just an amazing thing to watch, right? But the moment it starts going down, that's where a lot of people can lose their minds. They can start hating on DeFi and calling it a scam, and people that don't understand how impermanent laws, all of this management works, this is the moment where they will say, oh, this is nonsense, right? So let's take a look at this example. Okay, so the big problem occurs if the market is going down. So for example, we have the same pool, right? Jupe Solana, Jupe price is 0.9, range is 0.66, 1.2. So at this point, you are still mostly in Solanas, let's say, and let's say the Jupiter price starts to go down. Jupiter will go down if Solana is going down as well. That's just like a correlations between assets, like if BTC is going down, in most cases the whole market is following, right? So if, for example, Solana is going down, most of the Solana ecosystem coins, with some exceptions, of course, natural, but most of the Solana highest market cap coins will also go down, right? So if you see Jupiter going down, it means that most likely Solana is also going down. So your deposit value, your position value is going down as well. So you earn the fees in both assets, right? In Jupe and Solana, and your earned fees are also going down in value, right? Because you are earning in both volatile assets, you are exposed from both sides. So if something's going down, in most cases both of the assets will be going down, and if that's the case, your deposit value is going down, right? And your fees earned, right, the pending yield is also going down. So if you get out of range from the lower side, you are now, so let's say Jupiter dropped below 0.66, you are now fully in Jupiter, which lost quite a bit of value already on the way down. Plus you lost value from Solana because Sol also moved down most likely, right? And if both assets are still dropping, you are losing even more from the pending fees. So at this point you were mostly in Solanas, let's say 80% Solanas, 20% Jupe. It started going down, so Solana is going down, so that part of Solana is losing value. Jupiter is also going down, so that part, the remaining Jupiter part, is also losing value, and as it goes down, it loses more and more and more value. While, for example, if you would stay in Jupiter USDC pool, right, and Jupe starts to go down, yes, you are being converted to Jupe, but at least part of the pool remains in stablecoins, so it's not losing as much value. In that case, it's better exposure, right? But in this case, if market is going down aggressively, you are losing extreme amounts of money very quickly in percentage value, and then recovering from such positions are pretty much very difficult. It requires multi-step strategies and lots of patience, because essentially if everything dropped 20%, right, across the market, okay, and now you're sitting, maybe you had deposited 1k, maybe 10k into this pool, for example, and now you have, let's say, 8k value fully in Jupiter, and let's say Jupiter stabilized at around 40 cents or something, right? Let's say. So then there are options for you to still rebalance the pools, deposit only in Jupiter with very tight ranges to the upside, and try to pretty much hustle out the yield, the fees, and try to regenerate back as much fees as possible. And once you do that for a week or two, like extreme grinding in fees, then you can actually deposit once again fully in Jupiter with USDC in a higher range and expect the price to recover, right? But that's more like expectance and based on assumption that at some point market will recover. But you are more dependent on the market rather than if you would be in any other type of pool rather than volatile. So this is a very important lesson for all of you to understand that it's, yes, it's magical when everything is going up and you have volatile asset. It's perfect because everything is in green and you are just enjoying the yield plus additional profits from volatility exposure. But the moment it turns down on you, and this is the worst position, the worst pool to be in. So that's why, for my perspective, this is a very degen type of risks. When you have volatile pools, I rarely deploy capital into them unless it's just fun capital. And yeah, it's just, if I do anything like that, of course I will always post to DeFi House. But even so, if something happens quickly, I may not be able to always react right away. There are ways to hedge against these kind of things when you just simply set a limit orders on futures, perpetual futures platforms for shorts in case something goes really bad and market starts to drop down. So at least you would execute into a short position and cover part of the impermanent loss. But that's not always the case, right? So yeah, I mean, when the market is moving up, this is the best pool to be in. When it's going down, this is the worst, and that's why you have to combine. And usually for volatile stable, more pools, better ranges in the long run will be better than grinding, hustling and risking it all on the pools like volatile, okay? And when the market is moving up and the market is strong, being in stable pool, it's also one of the worst things because you are missing out on so much potential, right? So you just always think before you deploy and think what's your goal and where is the market. So thank you for watching this one. Hopefully it's been beneficial. And of course, as always, I will see you on the next video.